Man, if you've been glued to the news this week, you're probably feeling, well, totally overwhelmed, right? We're staring down the barrel of some unprecedented geopolitical shockwaves. And if you're a new investor, hey, that panic is completely justified. The macro world literally looks like it's on fire. But that brings us to the elephant in the room. Why on earth is Bitcoin holding the line? Let's dive into it. While traditional energy markets are just getting thrown into absolute chaos right now by the conflict in the Strait of Hormuz, crypto is doing something completely unexpected. It's absorbing the hit. Instead of collapsing, it's actually standing strong. So today, we're going to figure out exactly why that is. Okay, so here's our roadmap for today. First, we'll check the global market pulse. Second, translating institutional moves. Third, hidden dangers with exchanges. Fourth, our crypto security checklist. And finally, we'll wrap it all up with a weekly trading strategy. All right, starting off with section 1, the global market pulse. To really grasp why crypto survival right now is so impressive, we've got to understand the gravity of the fears dragging down the rest of the globe. The geopolitical risk premium is just flashing bright red everywhere. A merchant ship was attacked in the Strait of Hormuz, and in response, the IRGC Navy abruptly declared the strait totally closed to vessel traffic. It's a literal supply chain nightmare. And why does this matter to your portfolio? Well, because energy bottlenecks spark some severe inflationary fears. When oil spikes, you know it, the cost of absolutely everything goes up. Now, usually when a kinetic shock like this hits, traditional markets do one thing: they panic. In traditional finance, this nightmare scenario causes immediate capital flight to cash. Investors dump their risk on assets and just run for the hills, because cash feels safe when the world feels completely unpredictable. And this perfectly highlights the incredible divide we're seeing right now. On one side, traditional finance is experiencing that classic capital flight to cash. But on the flip side, crypto's doing the exact opposite. It's holding critical support. Despite all the overwhelming macro fear, despite everyone doom scrolling on social media, Bitcoin spent the entire week just fluctuating in this remarkably tight, narrow range, right between $62,000 and $65,000. It absorbed the initial shock of the conflict, took a quick dip down to that $62,000 support floor, and then immediately priced in the risk premium to recover. Guys, this resilience is a massive structural tell. When an asset stops selling off on terrible global news, it means the weak hands, they're already gone. The people who are going to panic sell have already done it. So that begs the question, what exactly gave Bitcoin the buoyancy to hold that line against all that geopolitical gravity? The answer is actually the US CPI data. For those newer to the space, CPI, the Consumer Price Index, is basically the main gauge we use to measure inflation. And we got a notably soft CPI print this week, meaning inflation was actually lower than the market feared. This was exactly what the Federal Reserve needed to see, and it instantly eased market expectations for future interest rate hikes. That little injection of dovish monetary sentiment was the exact saving grace that counterbalanced the Middle East conflict. It gave investors the green light to just keep holding. And look, the derivatives market proves this panic is officially over. Let's translate this data real quick, because it acts like a real-time mood ring for institutional traders. Implied volatility is really just a fancy way of measuring how wildly the market expects prices to swing. Think of it like insurance premiums, right? When a storm's coming, premiums go up. Well, Bitcoin's one-week implied volatility plummeted from 46% down to 36.8%. The storm has passed. Over on Ethereum, we look at skew, which measures whether investors are paying more to protect against a crash or to bet on a pump. ETH's one-week implied volatility eased from 57.6% down to 50.5%, and the skew, while still technically leaning bearish, fell drastically. Put simply, the market is explicitly telling us that the demand for aggressive downside protection has completely evaporated. We're shifting away from hyperreactivity and moving right into a slow, grinding consolidation phase. Okay, with the macro fears subsiding, let's move into section 2, translating institutional moves. Now, we really need to shift our focus from global events to what the massive institutional players, the whales, are actually doing behind the scenes. And this week, we got a historical shocker. First, we need to define a critical concept: the corporate pivot. A corporate pivot is a fundamental shift in a company's investment strategy. It's when a company goes from being a net demand driver, meaning they're always buying, soaking up liquidity, constantly absorbing supply, to a potential source of active selling. Keep this definition locked in your head, because arguably the most famous corporate buyer in the entire crypto space just completely changed the rules of the game. Yup, we have to talk about MicroStrategy. Michael Saylor's firm holds an astronomical amount of crypto, like over 840,000 Bitcoin. Their old strategy was famously simple: never sell, blindly buy Bitcoin at literally any price, and act like a giant black hole for global supply. But the paradigm just shifted. Between July 13th and July 19th, MicroStrategy sold 3,588 Bitcoins to pay preferred stock dividends and bolster its US dollar reserves. You really have to understand the gravity of this pivot. With an average buy price near $75,476 and current prices hovering around $64,000, MicroStrategy is sitting on an unrealized loss of over $11 billion. And yet, they sold. This is the largest historical divestment for the company, and it officially invalidates the whole sailor never sells thesis. I guess those laser eyes can only look past an $11 billion deficit for so long, right? So if MicroStrategy is sidelined as a blind buyer and has morphed into a potential source of active selling pressure, where on earth is the underlying demand coming from? Well, the answer is ETF flows, but with a major catch. We are seeing highly selective inflows and advanced rotation tactics. Capital just isn't blindly buying the entire index anymore like it did a year ago. Instead, investors are actively rotating. They're selling the geopolitical spikes when fear hits and buying the macroeconomic dips when inflation data softens. As a retail investor, you can't just sit back and rely on corporate treasuries to blindly prop up the market for you anymore. You've got to manage your own technical levels. It is a trader's market right now for sure, not a holder's market. Which brings us perfectly to Section 3, Hidden Dangers with Exchanges. Because look, even if you navigate the macro markets perfectly, even if you understand the geopolitical forces and track the whale movements, absolutely none of it matters if your funds get wiped out by institutional failures. So I want you to ask yourself a very direct question right now. Is your crypto actually safe? Really think about where your liquidity is sitting at this exact moment. Because the reality on the board this week for trading platforms is incredibly grim, and ignoring it could literally cost you everything. Just take a look at this data point from earlier this week. Crypto trading platform AscendEX just announced it is completely ceasing operations. They are entirely shutting their doors. Why is this happening? Well, they explicitly cited the crushing impact of the European Union's new MiCA regulations. The compliance costs associated with these new super strict rules act as a massive hidden tax that is just wiping out mid-tier exchanges. They literally cannot afford to operate legally anymore. The Wild West era of sketchy offshore exchanges is rapidly coming to a forced end. And because of these cascading exchange closures, we are moving immediately into Section 4, the Crypto Security Checklist. We're going to turn this alarming regulatory news into an urgent, actionable defense strategy for your personal portfolio today. Let's start with the absolute basics. A hot wallet is connected to the internet, like a browser extension on your laptop or an app on your phone. That makes it inherently vulnerable to sophisticated hacks. Cold storage, on the other hand, is an offline, physical hardware device, making it highly secure. And we actually have an active alert right now that proves why this distinction is quite literally the difference between keeping or losing your wealth. Zilliqa, a major Layer 1 protocol with millions in backing, just officially asked exchanges to pause all ZIL transfers following a suspected massive cold wallet theft. Think about the implications of that. If a Layer 1 protocol's sophisticated security setup can be compromised, your everyday hot wallet extension doesn't stand a chance. And that leads directly to the absolute most common beginner security mistakes I see constantly. Number 1, trusting hot wallet extensions unconditionally. People treat their browser extensions like bank vaults, and guys, they are not. Number 2, leaving long-term capital on Tier 2 offshore exchanges. If you are doing this right now, especially on non-compliant exchanges while MiCA regulations are bankrupting mid-tier platforms, you are taking a massive, totally unnecessary gamble. Finally, playing Russian roulette with your liquidity. What does that mean? It means connecting your primary hot wallet to some random, unaudited DeFi protocol just to chase a 5% yield. You're staking your life savings to make $50 in interest, only to have a malicious smart contract drain 100% of your principal. The market is just completely unforgiving to lazy security practices. So here is your definitive weekend survival checklist. Step 1, move your inactive capital offline immediately. If you aren't actively trading it this week, get it onto hardware. Step 2, verify your exchange's MiCA compliance. Look them up. If they aren't compliant or actively getting licensed, they might be the very next AscendEX to just shut down unexpectedly. Step 3, audit your custody setup surgically. This means taking 10 minutes to actively revoke token approvals you no longer use. Go into your wallet settings and unlink from dApps or decentralized exchanges you haven't visited in months. Clean house and eliminate all unnecessary risk. Seriously, do not skip these steps. All right, now that we've secured the perimeter and locked down the portfolio, let's pull all of this together in our final section. the weekly trading strategy. We've looked at the macro shocks, the institutional shifts, and the exchange risks. Now let's form a concrete, highly focused action plan for the days ahead. I want you to plant this number firmly in your mind, $62,000. This is your absolute line in the sand for Bitcoin this week. This is the critical support level. And support simply means the price point where buyers historically step in and stop an asset from falling any further. If Middle East tensions escalate dramatically and the $62,000 level permanently breaks, well, we're going to have to reevaluate the entire macro structure of the market. This is the exact floor that the soft inflation data successfully defended earlier. Watch it like a hawk. So, here is your weekly action plan summarizing everything we've learned today. Above all else, stay disciplined with your risk management. Keep a really close eye on that macro support structure holding the line at 62K. Remember the historic MicroStrategy pivot we discussed? Avoid blindly buying the entire index at random times because the whales aren't doing that anymore. They're trading strategically, and so should you. And finally, monitor the upside. Right now, upside resistance is hard capped at $65,000. We likely won't break past that until we see sustained aggressive ETF inflows that can completely override this new wave of institutional selling pressure. I want to leave you with a final provocative thought. This week, the US Commodity Futures Trading Commission, the CFTC, actively planned to block an application for a fast-tracked 24/7 oil contract. Why? Because they explicitly claim the traditional energy market isn't prepared for round-the-clock derivative contracts. Think about how absurd that is. Legacy markets are quite literally blocking innovation because they are terrified of weekend volatility. Crypto, on the other hand, it operates perfectly 24 hours a day, 7 days a week, 365 days a year, straight through massive global geopolitical crises. Its structural superiority has literally never been clearer. So the question is, are you prepared, disciplined, and secure enough to harness it? Stay sharp, protect your capital, and I'll see you in the next explainer.